Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. My name is Damaris Mukulu. I'm the head of brand marketing and communications at Genghis Capital. Today is May 31st, and we're super excited to have you here with us because our research team, headed by Churchill Ogutu, is going to take us through the local financial markets. In today's segment, we're going to focus solely on the local financial markets, and Churchill assures me that him and his team have a lot of content for us. So that's going to be super exciting. Both he, Wesely, and Melodie are going to walk us through the local fixed income opportunities. That's opportunities in treasury bills and bonds. They're also going to talk to us about the equities markets, that is in terms of stocks, what we should be watching, and the kind of activity that's taking place. If you haven't already, you could download the Jacuzzi app, which is available on your Android phone and also your Apple device. The Jacuzzi app allows you to take action of the things you're going to hear. So whether it's a buy or a sell recommendation, if you use this application, you'll be able to open a share trading account and actually execute on this. Our webinars are interactive. We love hearing from you. So please feel free to use the Q&A tab to send in any questions for Melodie, Wesely, or Churchill. And at the end of the segment, they're going to answer all of these particular queries. So I think we're ready to begin. Churchill and team, over to you.
Thank you, Damaris. Before we start, there's this interesting concept. It's called puente in Spanish, which is basically bridge. And it usually happens when there's a holiday either on a Tuesday or on a Thursday. And then you see there's a weekend in between. So ideally, this whole concept about puente means that a day like this, because it's a Monday between a weekend and tomorrow, which is a holiday, public holiday, so workers actually take a day off today in Spain.
You want us to get in trouble with HR or move to Spain, is what I'm getting.
No. That's the point I was driving, that because you're not in Spain, so we are fully working today, and that's why we are here to serve our clients and our participants. Good morning, everyone. Good morning, Damaris. I was not trying to create a revolution of sorts. So right on to our question. As Damaris said, we'll be looking at the macroeconomic, and then we'll look at the fixed income and also close with the equity segment. So I'll start with the macroeconomic, just a review for last week before I get into fixed income. And then I'll invite my colleagues, Melodie and Wesely, to walk us through the equities segment. So last week, we had the CBK MPC meeting, Monetary Policy Committee meeting, and it retained the central bank rate at 7%. This was within our expectations, and also the consensus was looking for a retention of this CBR at the 7% rate. The policymaker stated that inflation remains well anchored, basically between the band that it looks at between 2.5% to 7.5%. And today, actually, we'll be expecting it's scheduled for us to listen into the May inflation rate, so just to see what the number will be. The last number was at 5.76%. April private sector credit growth was at 6.8%, decline from 7.7% in March, and 9.7% in February. So it has been gradually coming down. But having said that, we just looked at the numbers, and we saw that for the month of April, the actual increase was a decline of 157.7 million in terms of the overall private sector credit stock. It declined in the month of April. So no brainer here. We know what happened in April. That is when there was the tighter containment measures. 5 counties were basically locked up. There was not much movement, and that had a negative impact even in the private sector sentiment. We saw the PMI print nosediving to 41.5 in that same month. And even banks themselves were not able now to extend credit as per this headline number that CBK mentioned to us. Moving on to the other metric that was mentioned in this MPC statement is now the current account deficit, which the CBK said that it was at 5.2% as at the end of April, and this is just a 12-month aggregate data. And for the expectations for the year, they're looking at the print to remain at 5.2%. And there are some highlights that were given, but you just poured through the data just to see the numbers, just to look at the numbers. So ideally, the MPC stated import growth and also the export growth. So we just reversed the numbers and we saw that the goods trade deficit, this is basically the deficit between exports of goods that were exported and goods that were imported are widened by 28%, 22% to 395 billion. And then the goods imports increased by 15.2% to 629.3 billion. And then the goods exports or exports of goods in the first 4 months increased by 5.5% to 34.1 billion. So ideally, the deficit between imports and exports is coming to that 395.2 billion, which was an increase of 22% in the first 4 months of this year versus the first 4 months last year. And ideally, we're looking at the biggest, the positive that we've seen when you look at the current account deficit is now diaspora remittance, which falls under secondary income. Those are basically the funds that come unilateral into the country. So as at the end of the first 4 months, we saw that the overall diaspora remittance was around $1.1 billion. That's around 121 billion shillings. And that was an increase of 23% against the same period last year. So that, in a way, summarizes the current account deficit. Some economics 101, I'll just look at it. And basically, because of this deficit that we're looking at, the current account deficit, it has to be funded. So ideally, because we are in a net dollar short position, because we import more than we export. So we are in need of dollars. So on the flip of that is that we need to finance this current account deficit, either through financial flows or capital flows. Financial flows, we look at things like even the foreign participation in the markets. A few slides down the line, we look at the data, or we look at the outflows or inflows for foreigners at the end of last week. So that is also falls into this whole conversation to do with current account deficit. How are we financing the current account deficit? The other issue outside even the equity flows, we have the FDIs, foreign development FDIs flows. So that is also part of the financing that we see. But the biggest chunk that we see is now the budget financing, or the external financial institutions financing the budget. That comes to fund in this deficit of current account deficits. And that is what is now the basis of these next 4 slides. We did a flash note Friday in the evening. It was around 5:45 p.m. to be sure. I know right that time a number of you had already packed their bags and started the weekend. But it also it came across us that it's something that we need to put to our clients, that these lumpy inflows that is expected in the course of the next month. We have these inflows totaling 264 billion shillings that is expected to come in the course of this in the course of June. That is the balance from the IMF financing. We have what is called the World Bank DPO, Development Policy Operation. The third one, we're expecting 82.5 billion. We have some monies from Africa Development Bank that is expected 13.8 billion. And then there's a potential Eurobond issue, 123.8 billion. So collectively it's coming to 264 billion shillings that is expected in the month of June. But having said that, we still look at June, the month of June. usually has an outsized tax collections. Looking at the statistics, the last 3 financial years, where we've been seeing that comparing the June tax receipts, comparing it with the previous 11 months, the financial year starts from July. So from July up until May, that's 11 months, and looking at the average tax receipts in that period, and then comparing with the month of June, for the last 3 financial years, you've seen that the June receipts have been higher than the average in the last 11 months. And that is what we expect to play out. And to be sure, with the average of the first 10 months of this financial year, that is between July up until April, we are looking at an estimate of around 119 billion shillings. So we estimate that even for the month of June, the tax receipts will be higher than this 119 billion, just looking at the trend that has played out in the last financial years. So to back, and then remember that we still have these external financial flows, 264 billion, and then we have an outsized tax receipts close to even 140 billion or 150 billion coming in. So you'll find that over the course of June, we'll have like close to 400 billion shillings in terms of financing, tax receipts, and also the financing that is now supposed to go to the budget expenditure side. But looking at the expenditure throughout this financial year, this is not the focus of our third table. We've seen that up until March 2021, the budget that had been spent was around 1.7 trillion shillings. That is comprising of the consolidated fund services, which is ideally servicing of public debts. We have the recurrent spending, we do have development spending, and also we have equitable revenue shares to the counties. So collectively, by the end of March 2021, it was coming to 1.7 trillion. But the overall spending in the current financial year, and that is what is on the extreme bar in the chart that you're seeing, is around 2.89 trillion shillings. So what that means is that between April to June, we are supposed to spend 1.2 trillion shillings for the budget. Because between July up until March, it was 1.7 trillion. So the balance around 1.2 trillion has to be spent in the next 3 months rather. So, but nonetheless, looking at the previous, still again, what has been the trend in the previous financial years? The black bar is now the actual budget spending, and then the maroonish bars are now the target spending. And you can clearly see from fiscal year 2014-15 up until fiscal year 2019-20, there's been an underperformance in terms of the actual that is spent in the budget vis-a-vis the target amount that was there. So we're looking at an average of 90%. So ideally, if you have a budget of 100 billion, so at the end of the financial year, we just end up having spent 90 billion. So there's a deficit of 10 billion, and that is the trend. So our point is, in as much as we are getting this 400 billion, there's that issue about slow absorption of funds, and ultimately we'll just end up with some cash at the end of the financial year, which will now have to be carried to the next financial year. And that then even the credibility of the budget execution and a whole host of things. So this whole issue about lumpy inflows coming towards the tail end of the financial year, I think it just undermines the budget execution. So that was the point of that flash note that we sent out on Friday evening. So moving on to macro calendar for the week, as earlier stated, I'm expecting today to see the May inflation rate. As at the end of April, it was at 5.76%. That is year on year, the headline number. We also have the core inflation, which was around 2.4% as at the end of April. fuel inflation came down slightly to 14.8%, and food inflation was around 6.4% thereabouts. We also expect to see if wishes were horses, we also expected to see first quarter 2021 unemployment rates being issued today. But you can clearly see we still haven't received the fourth quarter unemployment rate for last year. So it's just a wait and see situation with these unemployment prints. And finally, on Friday, we're expecting to see PMI, Purchasing Managers Index for Kenya for the month of May. Should be out by Friday. The last print was quite ugly. It came down to an 11-month low of 41.5. So just to wait and see whether positive sentiment emboldened in the private sector or it's still mellowed below 50. So ideally, any print above 50 for the PMI, below 50 in the PMI just indicates contraction in sentiment. Anything above 50 indicates expansion in sentiment. So at this point, let's just move on to the fixed income segment. A review of last week's activity, basically starting with the secondary market T-bonds. It rebounded by close to 62% week on week to 35 billion in terms of the overall turnover. This was basically boosted by the infrastructure bonds or IFBs, which accounted for roughly 54% of the trades that were executed over the course of last week. T-bills had an overall performance rate of 152%, which was in aggregate terms was 36.6 billion shillings, and yields came down across the tenors. And to be specific, for the month of March, I think for the month of May rather, we've seen like there's been an inflection point that was hit, whereby from October up until end of April, yields were generally on a gradual uptrend. But then from May, they've started easing off, and for the 182 day T-bill, it has declined 0.12% over the course of March, or over the course of May. And for the 364 day tenor has declined, I think, 0.32% in the course of May. So that is, we are seeing, it's like the government, or what the market is perceiving, is that the government has managed to attain its net domestic borrowing, and now it is even rejecting the bids that are coming in. And to be sure, we did an analysis of the T-bills, what is called the bid to cover ratio. So basically looking at the bids that came in, the bids that were received by CBK versus the bids that were accepted, and it came to a number of 1.56 multiple. So in layman's terms, it means that for every 100,000 that eventually got accepted by the CBK, the bids that had come in was 156,000. So ideally in the process, for every 156,000 bids that came in, CBK rejected 56,000 and ended up accepting 100,000. So that is what essentially that number is telling us. And that played out over the course of May. So that is a big number or amount that was rejected. And that is the proximate cause of this decline in the yields that we are seeing. Year to date, yields still are a bit elevated at 0.5% against the levels that we started the year with. So moving on to the liquidity trends, just telling us a bit of some mixed signals over here. If you look at the interbank activity, the average rate went up by 0.16% to 5.04%. Then in the open market operations, or OMO, CBK was actually mopping up excess liquidity via term auction deposits. We are seeing that as at today, the outstanding 7-day TADS is 15.3 billion. And then the weighted average rate is around 5.96%. 14-day TADS outstanding is 14.45 billion. Weighted average rate is 6.386%. As per our estimates of net domestic borrowing, we are seeing that as at the end of last week, we were sitting at around 435 billion, which is at roughly 80.5% of the target for the financial year. So moving on, and this is something that has come out today. It was in the daily today. Don't know whether it has been published by the NSE. EABL has a medium-term note in the corporate bond, 6 billion, and it has announced an early redemption on this particular paper. So ideally, what EABL had in mind was an 11 billion medium-term note, which was issued in two tranches. The first tranche was 5 billion. That one was already had been retired. And then the second tranche that was issued on the 3rd of April 2017, this is what and was expected to mature next year in March, around late March. So it was a 5-year paper. So EBABL has now called for an early redemption for this paper. According to its information memorandum, it's supposed to, if it wants to have an early maturity, at least within 15 days, give a notice of at least 15 days, but not more than 30 days of its redemption or on its early redemption. And this notice that has come out today fits in within those dates as per the information memorandum. So the initial use of proceeds of this 11 billion capex, capital expenditure, was 5.1 billion, and then working capital investments and general commercial purposes, another 5.9 billion. So that was the overall proceeds, where the proceeds of these two tranche bonds was meant to go into. For this particular paper, it had a coupon rate of 14.17%. As at the end of Friday's close, the indicative yield on this paper was 9.94%. And the dirty price, because the yield is lower than the coupon rate, the dirty price was higher than 100. So it was at 105.7. This is as at the end of Friday. As per EABL, looking at its total borrowings as at the end of June 2020, it was around 44.9 billion. That was the overall borrowing that it had. Long-term debt was 36.9 billion, short-term debt 8 billion. And we are seeing that based on this structure of borrowing, we have the medium-term bond. We have a significant chunk of it is now bank loans. A number of banks have EABL has managed to borrow from a number of banks. I think around 3 or 4 banks thereabouts. And the effective cost of the debt, which is around 44.9 billion, as at the end of the financial year, June 2020, the effective cost of debt was 9.7%. So you can clearly see that at a coupon rate of 14.17%, if it's been successfully retired or this early redemption, it will be able now to reduce the debt, the overall cost of debt as we get into the next financial year. So I think that's the overall end game. We've even had a conversation, quick conversation with their management, and then they said it's just this whole, the idea behind this early redemption is now to improve its balance sheet and also to lower the cost of funds. And it's clearly that's one of the things that we are that will be achieved with this early redemption of this paper. So the record date is 14th June, so that's 2 weeks away, and early redemption date is 28th June, which is a month away time. So record date ideally means that those bond holders as of the 14th of June will be entitled for this early redemption 2 weeks afterwards. Moving on to our week's trade. Ideally, this is a tactical trade whereby we have a buy on the April infrastructure bond paper. We're looking at levels between 12.1 to 12.15%. And the market is looking at expecting the June primary bond issue. And they expect by and large that a longer tenor paper will be issued by the CBK rather, not the market. Apologies for that. And the thought process is what I earlier mentioned. This high or elevated rejection at the T-bills market is just a sounding bell that CBK or the government is ahead of its borrowing target, and that also drove activity to the infrastructure bond, because right now the government is deemed to be well secure in terms of its borrowing, so there's not much pressure going forward. So that also drove activity to the infrastructure bond papers, and over the course of last week, as per earlier mentioned, and we expect that to continue in the course of this week before the announcement of next month's primary bond issue is made. So that is what we are looking at. And ideally, this paper is liquid. It has around 81.9 billion shillings outstanding. So it's quite a liquid infrastructure bond paper. So that is what we are likely to see trades coming around. So at this point, we now move to the equities. I'll be joined with my colleagues who will give their highlights at some points, but let me just walk you through the headline numbers. The indices went up last week. NASI is basically a market cap index, looking at the biggest, it's arranged according to their market caps at the bows. So we have Safaricom with the lion's share around 63% market cap, and then the banks following, and then I think EBABL rounding up the top 5 in terms of market cap. So looking at the activity in NASI went up last week 4.2%. NSE 20 went up 0.2%. This is price adjusted or price index, looking at how or the larger the price in terms of aggregate number, it has a bigger weighting in the NSE 20. So that NSE 20 index went up by 0.2%. Turnover went up 57% over the course of last week to roughly 5 billion. And the top gainers were BOC Kenya, Can General and Express. Top losers, East Africa Cables, Longhorn and Olympia. Let me invite Melodie to walk us through the banking sector. Melodie, over to you.
Sure. So last week was an eventful week for banks, with most of them reporting their Q1 results. So we'll start looking at Equity, which announced an impressive 64% rise in their earnings per share to 2.3 from 1.4. Mostly this performance was on the back of a substantial decrease in their loan loss provisions, which was a 59.3% decrease to 1.3 billion. And then the net interest income also went up 28.4% to 20.3 billion. But however, the interest expense on customer deposits weighed down on the net interest income after it rose 63.5% to 4.2 billion. Something of note is the non-interest revenue went up 30.7%, mostly due to foreign exchange trading income that grew an impressive 82.7% to 2 billion. This is mostly because of the volume of diaspora remittance that it has been processing, which went up from 82 billion, from 44 billion to 82 billion. And we've seen that Equity has really taken to digital banking, and it has partnered with more than 10 mobile money transfer platforms, rather Western Union, PayPal, World Remit, MoneyGram, and its own Equity Direct platform. So that's where the non-interest revenue came about, the performance rather. So looking at Equity, geographically, it's well diversified, and with 40% of its balance sheet is coming now from Rwanda and Uganda. And these subsidiaries are now delivering above the cost of capital return. So it shows that in the future, they have a very large revenue potential. So the other bank was StanChart, which announced a 19% rise in first quarter 21 earnings per share to 6.33, mostly due to non-interest revenue, which went up 11%, and decrease in the pre-provision expenses. As we saw last year, they had a voluntary retirement scheme, which reduced the number of staff. So that led to a decline in staff costs from 5.3% from the same period last year. And also it reduced its operating expenses 24%, mostly due to operational efficiencies and the branch rationalization program that they had the previous years. The loan provision went down 3.5%, but its gross NPLs, that is non-performing loans, went up 11.3%, sorry, to 22.3 billion. And also investment in government securities went up, and it's been maintaining a very liquid balance sheet, of which it's 74%. But looking at its NPL ratio, the non-performing loan ratio, it's quite high at 16.4 if you compare it with the sector average right now at 14.2%. So I think that's something that they should look into. And mostly it's just basically due to the economic status at the moment, like most companies are struggling. But hopefully now that the economy has reopened, things will get better with time. And looking at their digitalization, they've introduced video banking, which is a new way to recruit customers and cut costs. And they also recently, late last week, announced that they're planning to upgrade all the ATMs to accept checks. Though this upgrade comes at a time when check deposits, like check processing, has stagnated at about 1.4 million, at a value of about 200 billion per month. And in around 2009, the value of checks had been capped at 1 million shillings to reduce, rather to promote RTGSs, and also because checks are vulnerable to fraud. So that's also another aspect to look at, and they take 3 days to clear, while RTGSs are more or less instantaneous. So let's see how that strategy works out for them. And lastly, we have KCB that had a marginal rise in profit around 2% to 6.4 billion. And its acquisition, National Bank of Kenya, NBK, had a profit of about 184 million, which is a 19% rise from 154.9 billion the same time duration. So mostly the growth of KCB was due to an 11% increase in net interest income, though this was subdued a bit by a drop in non-interest revenue. So this is revenue from things like fees and commissions from mobile banking and other avenues. So when we look at the KCB and Pesa disbursements, they went down 51%, which led to mobile loans having a 28% dip. So looking at an overall, 97% of the total transactions of the bank were done outside the brick and mortar, the traditional brick and mortar branches, of which 79% of them were on mobile, and branch tellers only handling 3%. So we can see most banks now are focusing on digitalization to support their net non-income revenue growth and also to encourage cost efficiency. So the group had their AGM on the 27th, where it approved the acquisition of BPR Bank in Rwanda and Bank ABC in Tanzania, as it seeks to expand and get new growth opportunities in the region. So once this transaction is complete, hopefully it will see the bank's balance sheets going up to 1 trillion shillings, amount that had grossed by equity last year. So looking at KCB's non-performing loan, unfortunately, they've been going up for the last 4 quarters as a result of the pandemic. And they rose to 98 billion, which is a 48% increase, mainly because of the corporate book that they're holding. And this led to the non-performing loan ratio to go down to 14.9%, which is actually higher than the sector average, which is 40.2 as at April. So that they also reported a decline in loan loss provisions to 2.9 billion. So I think KCB is going to do more to look at its asset book and how to make sure that they get their non-performing loans under control. So in overall, most banks right now are holding most of their cash in government securities as they're trying to mitigate against credit risk exposure. And looking at the NPL ratio, which is 14.2 at the moment, comparing it with what it was earlier around February, which was 14.5, we can see that there's some slow improvement in the NPL ratios. So hopefully with time, now that the lockdown has been lifted and that the moratorium that had been given by CBK for people to repay loans, I think it crossed in March. I think now we'll see that the net interest income will start going up again. And that's what I have from my end. Back to you, Churchill.
Thanks, Melodie. So let's move on to foreign participants, where we saw last week the participation by foreigners was 60%, with inflows of 776 million shillings. Foreigners were accumulating on Safaricom, Equity, EBABL, and then Babori, and then they exited on KCB Group. So at this point, let me just call Wesely to give us some insights on Safaricom. Wes, over to you.
Good morning to you. We've been on the lookout over the week as more details on the Ethiopian venture unfolded against the backdrop of the announcement that was made last weekend. The price action on the counter broke its 52-week high shortly after the markets opened on Monday. The rally crested in a slight uptick on Friday when the markets closed, in part due to the fact that the project kicks off next year and that much isn't clear on the venture. So far, we understand that the Netherlands was a smart pick for the joint partnership of Ethiopia, GPE in short, that may have been driven partly by a bilateral investment treaty between Netherlands and Ethiopia. The treaty was signed in 2003, came to force in 2005, and it's likely to run to 2045 ceteris paribus. That covers the ECA's license time horizon shy a few years. Also, the Global Partnership for Ethiopia will operate in the country under an operating company. This implies that the GPE will own all the assets under the operating company, but the right of utilization and use will be on the OPCO company. The shareholding in the OPCO has Safaricom holding a 55.7% stake. Sumitomo, which is a Japanese corporation renowned for heavy metalworks and its dominant media presence in the country, holds 22.7%, leaving CDC Group, a UK government-owned development finance institution, owning 10.9% and 6.2% on Vodacom. The consortium is neatly structured in that it has operators, contractors, and financiers in there. And we are waiting to get some more color on the special purpose vehicle dubbed Safaricom Family Ethiopia when it will get some registration and comes into the country. On matters Safaricom, that's it so far. Back to you, sir.
Thanks, Wes, for that. You've thrown in a Latin word which caught me a bit flat-footed, ceteris paribus, which means all things held constant for some of the participants who may not be aware of that. So looking at where the NSE sits in terms of its select African peers, The price to earnings ratio for NSE All Share Index is around 14.5 multiple against a median of 12 multiple. Dividend yield is lower at 2.2% against a median of 5.2%, offered by, I think, the Nigerian markets. Moving on to the corporate calendar for this week, we're just expecting today's the book closure date for Kakuzi, final dividend of 18 shillings. And then on Wednesday, we have Sasini, 50 cents interim dividend. And then on Friday, we have NSC, final dividend of 53 cents. So that's about it in terms of the book closure dates over the course of this week. I will still have a number of announcements that have come in, the rights issue by Crown Paints, where it intends to raise 711 million, and 711.81 million shillings from a rights issue. So they want to, they had an AGM whereby the shareholders approved an additional 71 million shares, 181,000 additional shares. That was last year. Sorry. And then each of these additional shares, they're expecting at least 10 shillings. So for it to be at 711.81. Currently, the sorry about that. Currently, the price for Crown Paints as at the end of last week, it was 39 shillings. So this rights issue is heavily discounted. So to attract clients at 10 shillings per share. So, but I think what is awaiting is it's pending approval by NSE. CMA has given it the green light. So there's just that final approval from NSE to be issued. And what we are seeing from this rights issue is that for every one share that an investor has, an investor is entitled to one share. So it's 1-to-1 ratio between the existing shares and the rights issue, 1-to-1. So we move to TransCentury, which next week it will have its AGM for full year 2019 results, happening close to 2 years later, whereby clients or shareholders will have to approve this proposal for an additional 2 billion new shares, which will now go to facilitate the rights issue. Its rights issue. So ideally, they are looking at the rights issue. It will be something in the order of 5 new shares for every 1 new share that is currently existing. Just looking at the numbers for TransCentury ahead of this AGM next week, we are seeing as at the end of full year 2019, they were sitting at equity of negative 7.1 billion. And then this slightly went higher to negative 8.4 billion as at the end of first half. This is the last numbers that we have, first half of last year. That is as at the end of June 2020. So you can see the rights issue, it's now going to spur its equity position from this negative 8.4 billion that it is as at the end of June 2020. And then finally, we have this news that came over the weekend from Nation Media, just giving some final details in regards to the share buyback issue. We are saying that it has said that the buyback price will be something between a minimum price equivalent to par value, which is around 2 shillings and 50 cents. And then the maximum buyback price is 25 shillings. So you are saying that it's within a range of between 2.5 shillings to 25 shillings, though obviously the market is looking at it in an asymmetric. They're looking at the upside, the upper maximum buyback price, which is 25 shillings, and as compared to the whole range. So what this media company entails to buy back from the market, right now it has close to 207 million shares outstanding. So to buy back approximately 10% of that, so that's roughly 20.7 million shares to be bought back from this process. And this will be subject to shareholder approval. It will have its AGM on the 25th of June, so that's a month away. And then from 28th of June is when this buyback, if the shareholders approve, the buyback will now commence at the open market. So open market, and then it will close either once this 10% has been achieved, or Friday, 24th of September, 2021. So how we're looking at it, and this is also something that we put out in our weekly bulletin today, is that there could be some speculation, because this asymmetry, people are just looking at the maximum price, which is 25 shillings. And between, we're looking at the upside of around 44% thereabout from the close that was there over the as at the end of last week, as compared to this 25 shillings. But remember, we are looking at it, the buyback is not just a single price. It is between 2.5 shillings to 25 shillings. So it will be anything in between. But because of the asymmetry, people want now to see the upper maximum side. And of course, the counter is heavily discounted. If you look at its PB, price to book ratio, it's quite, I think it's 0.4 multiple. And this is where investors have been discounting the price or the counter just based on the industry trends that you've seen, a bit of digitization. And over the years from 2014, thereabout, we've seen a gradual decline in the price of NMG to where it is below 20s. Finally, let me just invite Melodie to walk us through this week's trading idea on the equities. Melodie.
So this week we were looking at ABSA for a buy recommendation, mainly due to its performance. It's 23.7% year-on-year rise in the earnings per share, and also the absence of its exceptional item on the statement during the previous quarter, rather the quarter 1 2020. So this exceptional item was the separation cost that it had incurred when separating from Barclays Bank. So we see when now it will be more flexible in its strategies, and now we expect it to focus more on its digitization. And it had set aside about 1.6 billion to introduce some more digital products that they have on hand. So we'll see that in the coming year. And because it also has its dividend play that will continue, and we see 21.5% upside from our target price. Back to you, Churchill.
Yeah, and that is it. Brings an end to our presentation. So back to Damaris to walk us through the Q&A questions. Damaris.
Thank you, Churchill, Wesely, and Melodie. You guys did great. Melodie and Wesely, you're getting a lot of positive feedback. Just, I know in the future briefings, we'll share the presentations you're actually walking our investors through. So we have two questions that have come through. Both are based on Safaricom. The first is from Richard Mwangi. So Richard states that we all woke up to the news that Safaricom made 314 million loss in the Pesa Africa joint venture. Is this likely to affect the Safaricom share price? I'd like to group it with the question from Felix. Felix wants to talk about the entry to Ethiopia. What does it mean to the shareholders in the midterm, and what's the outlook of its share price in the same horizon? So we have the loss of Pesa Africa that was reported this morning, but then we also have this new joint business venture.
Thanks. Let me just pick on that Pesa Africa JV. And it happened, remember that last year, March last year, they had Vodafone and Safaricom. They had, that transfer of M-Pesa, the brand, now into this M-Pesa Africa. And then they realized some profit just based on that transaction. So this year, or rather the financials that were released 2 weeks ago, they had that 314 million shillings that you see as a loss. So it's not something that even the management, because it's something that came out in their analyst call, but it's something that even the management was quite aware of, that year one, post this transaction, this Pesa Africa, they'll not be able to make any money before the costs are still fixed, before now they generate the necessary revenue. So that's where they are sitting at a loss of 314 million based on the full year 21 numbers. So it's something that was expected. By over the coming years, management is quite optimistic that they'll be able to make money from this joint venture. So that was from the management's perspective. There are issues on.
Before you move on, Churchill, I just want to clarify that you're saying that the loss was expected and therefore we don't anticipate the share price to get any sort of impact from that reporting.
So what I mean is the cost of now realizing this joint venture. Remember that this is a new entity. The costs remain the same, but before you realize a revenue, it takes some time. This is a new entity. It's just that for the previous year, because it was a one-off transfer, there's some gains that were realized based on that transfer of the brand from Vodafone into this new entity. And because it's a joint venture, so there's a 50-50 split between Safaricom and Vodacom, the one in South Africa. So that's where the profit came in the previous financial year. But because over the course between April last year up until March this year, the cost for operating this JV is stagnant and revenues are slow to come through because this is the first of operation. So that is where they expected that it will not make a profit. This is the management's perspective. So I don't know whether I've answered you, Damaris.
You have, Churchill.
Okay.
So while you were elaborating on that, Ian added on to the question about Ethiopia, and Ian's concern, I think, is based. Sorry, there was an echo. Ian's concern, I think, is based on Ethiopia being a very closed economy. So he's asking whether Safaricom's entry to Ethiopia will be affected by their take-on in terms of repatriation, because we have a company, Dangote Cement, who are still struggling to get over 150 million sent back to their home country, I guess, from Ethiopia. I don't know if that question was clear for you, Churchill.
Yeah, I think that's a risk. It's a major risk because of the controls that are there in the country, Ethiopia, whereby I don't know if you've had dealings with Ethiopian entities or Ethiopian individuals. It tends to be a bit a hurdle trying to repatriate funds from Ethiopia to either Kenya or, as per the case highlighted by Ian, with Dangote. So I don't know how Safaricom will be able to navigate that. I think we will be having a call with them in Wednesday in the evening, just to expound further on this deal getting into Ethiopia. I know that is one of the risks that we are seeing. What is the CapEx, capital expenditure, as per what was announced? Initial term for this venture is 15 years, and then it can be renewed for another 15 years. Wesely did some research and looked at how this whole JV or the OPCO that is getting into Ethiopia, and then this whole dealings with the Netherlands, how to circumnavigate some of the hurdles that are there. So perhaps they already have anticipated these issues to do with the repatriation of funds, but they'll be able to work their way around it, yeah.
Okay, all right, thank you for that, Churchill. If we go to your stock recommendation for this week, which was the buy on ABSA, Nelco would like to know your stock target price. Basically, what's the target price you set for ABSA?
Hi, the target price was 11.57 for ABSA.
Okay, 11.57. Thanks, Melodie. I believe that actually brings us to the question of our Q&As for today. If there are any other questions that any attendee may have, you can find us on any of the social media spaces. Feel free to send them over. We'll see you next week, Monday. It'll be a new month. It'll be the last month of Q2. So super excited to see what we can do. I can't believe that the year is almost halfway through. I'm a bit in shock. But hopefully it'll be a profitable year for everyone. So thank you, Churchill, Melodie, and Wesely. Thank you all attendees, and have an awesome week ahead. Enjoy your holiday tomorrow, and we'll see you then. Bye. Okay, I'm so sorry. I usually don't like this. I am truly, truly sorry. I really don't like doing this. My apologies. It's only because I've seen Titus and Ian have sent 2 questions not related to Safaricom, because I actually thought today's briefing was purely about Safaricom. So I think it's only fair to just answer their questions. So my apologies. Titus says that most investors are exiting KCB stock and accumulating equity. What's the reason for the exit on KCB? Is it the weak fundamentals as compared to those of equity? And then Ian asked a question about what is the drive, or rather the driver in the rise in revenues in Bamburi, yet they're not doing the expressway. So Ian is saying, why is Bamburi having a rise in revenue and they're not doing a lot of construction? So guys, maybe we could quickly answer that and then adjourn.
Let me take the question on Bamburi. Well, for Bamburi, the spotlight is on Hima Cement. For the past few weeks, the share price was on a decline because of the negative knock that it received on 3 French banks that reversed cause of financing the project. But I think it was 2 weeks ago when President Museveni and Her Excellency Suluhu Hassan signed a HGA agreement, and the construction for the pipeline project is expected to begin soon. So that's a positive news because Hima Cement is expected to profit in volume productions on that project.
So you're saying that that particular decision on the construction of the pipeline is the reason why we are seeing a rise in revenue for Bamburi?
Yes, because there are speculations on Bamburi profiting from this through Hima Cement, which is a subsidiary of Bamburi.
Perfect.
So Churchill, might you have something to add on that?
Okay, that could be a function of the price, current price, but I think what Ian was asking was in terms of the revenue. This is now the full year 20 revenue. So looking at the fundamentals of the industry, cement production, cement consumption, in as much as last year we had COVID-19 being acute between second quarter and third quarter, despite our expectations, construction, real estate, there was some boom. Just looking at the headline numbers, consumption and production of cement, and that had a positive knock on cement being manufactured by Bamburi. I know Bamburi right now has close to 32% of the market share. So whatever is happening in the broader cement consumption and sales has some spillover effect even in Bamburi. So despite even the fact expressway, I think the next round of numbers that we'll see will be able to determine whether they benefited from this expressway. But in any case, perhaps there are some other projects that they are looking at supplying in other private sector areas apart from the public expenditure. So we'll wait and see the full year 21 numbers to see whether there was that impact of the expressway on their revenue.
Okay. All right, Churchill. How about the second question on the KCB stock?
I'll handle that one. So for now, I think mostly people are accumulating equity from the results that they posted. So it's more of sentiment, but also looking at their fundamentals, they're quite strong. KCB has also had a very steep increase in its non-performing loans. So that could be one of the factors that investors are looking at. But all in all, maybe also foreign investors are reallocating their portfolios. So that could also be one of the reasons. Anything else you'd like to add, Churchill?
Yeah, you've captured it. Thanks, Melodie.
All right, then. Thank you so much, team. Apologies for the false conclusion, but now I can definitively say that we have answered all the questions raised. Have a great week and see you next Monday.